Hi, I'm Pattu from freefincal. So yesterday I had posted my portfolio update as on September 2020, and there were quite a few reactions to it, good, bad, ugly. And so I thought I'll follow it up with my stock portfolio and some clarifications for yesterday's video. So this is my stock portfolio, the weights as on September 12th, I think. And the returns that you see, they are from simplywall.st. That's where I track my portfolio, but I have not entered the last 5 or 6 transactions. It's current, but I've not entered the last 5 or 6, so it should have gone down a little bit, gone up a little bit. I don't know, whatever. I honestly don't care. The portfolio is just too small for me to worry about total return, this and that. That's just childish to do. I honestly don't care. Please recognize I am at a stage in life where my goals have been accomplished, or at least on their track, with the help of mutual funds. When I say I am building my direct equity portfolio, I am not building it at the expense of my equity portfolio. Equity mutual fund portfolio. What I mean is, if I have been investing 100 rupees in equity mutual funds so far before the starting of this direct equity portfolio, the same 100 rupees I am investing, or maybe more over years, or maybe more, I am investing at the same rate in equity mutual funds. I am anything additional, I am investing in the direct equity portfolio. That's all. So please, I'm not, but it just so happens that it's growing in weightage. That's a different matter. And I'm not doing any great balance sheet analysis. I'm not a value investor. I'm not doing all that. I try to look at low volatility. I try to look at the dividend, and I also look at the debt of the company. The debt should be low. Generally, not all of my stocks are like that. You can't don't find fault immediately in saying it's very easy to do that. But I don't care anyway. What else do I do? I also try to look at stocks, try to pick stocks that are trading close to its all-time high. Not all of them, but some of them. You can see that it's very heavy towards Hindustan Unilever. That's because of a mistake I did. I did not anticipate. I mean, in my mind, I thought Hindustan Unilever was actually a stock that trades at a much lower level than its 2000-ish rupees. So when I placed an order, I placed some X number of shares, and most of my money vanished, and that everything went there because of I didn't realize the price. That's why it became very heavy towards HUL. So I'll try to correct it in the coming months. I'm still at a stage where I can correct the weights by just changing the investment amounts. At this level, I can do that. So I'll be increasing TCS, Infi, ITC, those kind of companies. It's just fun. I mean, I'm just having fun. Please don't follow what I'm doing without understanding why I'm doing it. I'm having fun. I want a stable portfolio with a very low beta compared to the market, very low volatility, and whatever dividend comes, it comes. It's going to be small as of now, but my goal is over the next few years, my quarterly dividend should be equal to my 1 month's annual expense. That's my initial milestone. We'll see. So I tracked the portfolio at simplywall.st. I had run through this portfolio, this website sometime back. I don't remember. And you can see the snowflake of the portfolio here. It's high on health, reasonable past, reasonable dividends, not so great future. So beware. It's not a value portfolio at all. And I don't want to buy value stocks. That's going to be trouble, and I don't want to take risk buying value stocks. It gives you a nice these kind of, it gives you all these diversification, whatever valuation, all that, EPS, EP, future growth, all those things are nicely given. There's a free version. I'm a paid subscriber. I got a nice discount during the Black Friday, that kind of weekend. So maybe if you sign up for a free account, you might get a discount. I don't know. I'm not recommending it. It's up to you. There should be 100 portals that also do it. As part of Zerodha, I also have, I forget, there's one more, there are two apps associated with Zerodha. One is a stock screener and the other gives you the fundamentals, etc., technicals. I completely forgot. I don't look at it. Anyway, so have a look at it. All right. So yesterday I talked about quantum long-term equity and that my XIRR is 3%. I anticipated reactions to it, and certainly I got it. If you go back and look at the comments, how many people had asked, but two, why are you still holding on to quantum long-term Nifty? If they had asked me that question, I would have given them a nice answer. But if you are going to sit in judgment of my portfolio decisions without understanding my thought process, my requirements, my mentality, I have only two words to say to you. The second word is off. Now, I have always been a low volatility chaser. I prefer low volatility, and quantum long-term equity has satisfied that requirement over the years very admirably. And if you look at this, and in terms of performance, if you look at this is a screen grab from Value Research. This is with respect to BSE 100, but with respect to Sensex should be more or less similar. Notice that the underperformance started roundabout at the time January 2018. That's around the time when the market imbalance started showing up. That is, market imbalance means Nifty being driven by just a few stocks, huge difference in returns between Nifty 50 and Nifty 50 equal weight. So any fund that does not hold the top few stocks of Nifty 50 will not perform well. As a value fund, it's quite possible that quantum is not holding those top 50, the top stocks of Nifty. It's quite possible. I am not checked. Maybe like Reliance, something like that. It's possible. It's very hard to do all this kind of analysis. I'm not. So after that, it has not been doing well. And my belief is that when this market imbalance corrects, if and when it corrects, it should recover and do much better. That is my belief. I don't want to trust my belief because it's not based on any analytics on other people. So I removed it from my plumb line because I had mentioned it clearly that it's not something that young earners would have the patience to stick with. I have the patience to stick with it. It works for me and I'm sticking with it. If you have a problem with it, go ahead. I mean, as a DIY investor, I want to make something very clear to you. As a DIY investor, I live and die by my own decisions. If I make a mistake, I will blame myself. If my picks or my decisions turn out to be good ones, then I blame it on luck. That's all. I don't go ahead and claim that I'm a great fund picker. I do great analysis. I have always maintained that it is discipline which has taken me where I am. I don't have any special skills. Even when I keep saying this, I get a lot of criticism over my great fund choices, but that's how the world is today. You have to just learn to ignore it. So it works for me. I am sticking to it. If you think it's a bad decision, if you think I am not a good mutual fund analyst, please go do something else. Thank you. So, and then there was another question on XIRR, why the fund XIRR is higher, the net XIRR is lower than that. XIRR is a very complex quantity and it's weighted using time. If I have 3 funds, you can't take the weights of each fund, multiply the returns by the weights and get the net XIRR. It doesn't work like that because I could have started one fund in 2008, another fund in 2012, another fund in 2016. They're started on different times, and when I calculate the XIRR of the individual fund, they are with respect to the inception date of that fund, my inception. Now, if I put them all together, they need not give me the simple portfolio weight into return kind of. It doesn't work like that. I think investors should stop trying to find meaning for their XIRR values. I certainly don't have any kind of. I just show it because it's of interest to people and so on. I don't know what else to show. I can't tell you my portfolio value. Other than that, I don't sit and analyze my XIRR. I just don't do it. And I think it's in March March 27, 2020, the net XIRR was 2.75%. Today it's 9ish something. It doesn't mean anything. It's just going to fluctuate up and down. The goals, milestones, all that remains the same. All right. So finally, why are you not investing in index funds? Now, see, portfolio or investment decisions in general have to be taken with respect to an individual's personal requirements, mentality, age, everything. I certainly can't be investing like what a 25-year-old should be investing. I had said a young person can invest in Nifty Next 50. I can't go and put my money in Nifty Next 50 at my age because it's too volatile for me. I don't want my money to be that volatile, right? It's a requirement, and it's a personalized requirement. I have always been chasing after a low volatility portfolio, and I have never been chasing after returns. I have never made a big deal about how look my portfolio has bet even to myself personally, privately. I have never made a big deal of how much more return than the index my portfolio has got. I have never bothered to look at those things, but I have only looked at how stable the portfolio is, and my fund picks have been reasonably stable. And I would like to stick to hybrid funds and diversified funds. PPFAS is a fairly diversified fund. It is across market cap, across sectors, geographies, and so on. That has been my aim. Aggressive hybrid funds, PPFAS, and ICICI Dynamic. I specifically picked it for its low volatility. It became multi-asset. I don't see any reason to change it. Fine. I thought, okay, let's have some gold in the portfolio. It's going to be a little bit. Let it leave it like that. Only Mire became large cap after it was from India opportunities, kind of large and mid capish kind of fund. It became large cap, but after it became large cap, I have not invested much in it. I just left off whatever is there in it. I don't see any flaming hurry to go and change my portfolio. I mean, I'm not going to break something that's. I mean, I'm not going to fix something that's not broken. I'm not going to break something that's not broken. Also, is fine. It's just not. I think inertia for an investor is something very, very important. Unnecessary changes. Today, SEBI has come up with a circular. Then people are asking, "Oh, should I exit from my multi-cap fund?" Parag Parikh came out with a change in fundamental attribute about covered what is it? Call option something. Oh, should I change my fund? Oh my God! Stop reacting to every development around you. It's immature, to say the very least. I don't want to react, and that is the reason why my portfolio is healthy. I keep saying this. Don't. It's like portfolio management is like sculpting. You're sculpting a statue. You should know when to stop. If you don't know when to stop sculpting, what was a rock once will become a rock again. So for my individual requirement, I don't see any need or any rush to move to index funds. I like my portfolio. It's offering me low volatility. I'm fairly protected. Why are you worried about the extra expenses that I'm spending? I'm a rich guy. I don't mind paying off that extra expenses for that low volatility. In terms of advice, I have said, look, if you want, avoid active large cap funds, go to Nifty Next 50, combine that across. You can use that to find combinations across mid cap, large cap, mid cap, whatever. Or you stick to aggressive hybrid funds or hybrid funds, whatever is comfortable for you. At least there, the extra expense ratio is reasonably justified because there are no index hybrid funds. That's the second best option that you have. So it depends on what you want to do. I know what I want to do. It is only when people don't know what they really want, they start worrying about, oh, why is this guy doing that? Why is that guy doing that? So that's pretty much what I have to say. Bye-bye.